Cyclicity. It's all about the big picture. Whenever you're looking at any market in order to trade it, you really are looking at the overall big picture. I've made reference so far to price action and how those can be put together, how those bars can be put together to create a bigger picture and a sequence of events that happen so that you can understand the direction the market is possibly taking so that you can therefore take advantage of it. So there's a funny old saying. It goes like this: trade with the trend because the trend is your friend until the bend in the end. Cyclicity helps you to work out whether the market is trending and in which direction. When you understand how, it can show you effective entry and exit signals. Therefore, you can trade with the trend and take advantage of the move that's happening within the market. So this is how we look at cyclicity. As traders, there is no certainty, as I like to call it, in the market. The only certainty you can really take in terms of which way is the market going is when you see minimum standards in terms of behavior. So from a cyclicity perspective, if you see the chart moving in an upward direction, we'll deal with downward direction in a minute, what you are looking for is you are looking for price to move away from the trend, but with the trend. That's called a phase one. Phase one is always with the trend, and phase two will always be a retracement, or what we call against the trend, back to bounce and then go off back into another phase one along with the trend, and phase two will be a retracement against the trend. As a trader, you need to see two complete cycles for a trend to be established. So therefore, as a trader, if you're looking at a price chart, you are looking to establish a trend by seeing a minimum of two complete cycles in order to, on a high probability basis, be able to say that in this case you have an uptrend. So if you look at this chart here, we've marked 1, 2, 3, 4 and points 5. So we are going to look at some advanced price action patterns that we can look to see at the end of a phase 2, which would in this case be marked as point 3 and 5, in order to take advantage of the phase 1 as early as possible. So if you have a look here, we've said show where you would like to buy or sell. You can either do nothing, you can either enter a buy, enter a sell, enter an exit, or exit the sell. You would look to enter a buy order at the start of points 1, 3 and 5, and you would look to exit the buy towards as much as possible the end of a phase 1. What you would not do is look to enter a sell on points 2 and 4 to sell in a phase 2, because at the moment this is what we would call trading against the trend, and there is a specific way to approach that and do that as safely as possible. So just to clarify, you would look to enter buying orders potentially when you see the market completed a phase 1 and a phase 2 with 2 cycles, and then you would look to enter a buy order at the start of the following phase 1. This is what that might look like. So the red dot would signify a part of the order which we call a stop loss. The blue line would be an entry point, and the green line would show where you would look to come out of the trade. So as a trader, you would look to establish two complete cycles of phase 1 and phase 2. So let's imagine that these two cycles are cycle 3 and cycle 4. You would look to enter at the start of a phase 1 and then exit towards the end of a phase one, and always have a stop loss in place so that your account is as risk managed as possible. In a downtrend, you can see here that we now have phase one and phase two going in the opposite direction. This would be a downtrend. So taking the same way of thinking, you would look for two complete cycles of phase one and phase two. Let's imagine these are cycles 3 and 4. And 1, 2, 3, 4, and 5 are the points to discuss. You would look to place a sell order at the start of a phase 1, which would be points 1, 3, and 5 here, to exit towards and take the profit, by that I mean, at the end of a phase 1. What you would not do is enter a buy order at points 2 and 4 to take advantage of phase 2. Again, phase 2 trading, there's a very specific way to approach that. You would only look to trade a short trade, so a selling action trade in the phase 1 of the new cycles. Fractals are a way that the computer looks at high and lows in the marketplace. So this takes a slightly different viewpoint of cyclicity. You can see here that the end of the cycle is marked by a black diamond. On the chart, in some of the strategies, you will see that actually a fractal can also be designated by a small grey triangle. You can see there's two triangles there, one above and one below. These are different ways of marking the fractal pattern. This would be applicable specifically to a strategy that you will learn called volatility reversal, where fractals will be explained in more detail.